Now, let's focus on how to spot money laundering. As mentioned in our previous lessons, criminals aim to make the origin of their money seem legitimate. Therefore, as part of their money laundering scheme, they need access to the formal financial system in the form of bank accounts or access to sellers of high-value goods that accept cash. In order to reduce the opportunities for criminals to launder their money, banks, financial services providers, and other regulated entities need to integrate KYC and transaction monitoring practices into their business procedures. FATF, as well as National Financial Intelligence Units, FIUs, and private companies, have developed scenarios, typologies, and red flags for identifying financial crime. A company can also develop their own red flags to help detect money laundering as well as other crimes. Transactions that appear suspicious are red flagged, however, it cannot be ascertained with surety that the transaction is in fact related to money laundering. A red flag means that further scrutiny is required. Let's look at this in practice. KYC can be conducted upon onboarding a new client to find out indications of potential money laundering. You could ask the following when assessing a client. The authenticity of the documents, are they genuine or fake? Is the client secretive or reluctant to share information about the business that they have or why they want to open an account? Is the client a politically exposed person? Is the client convicted of financial crimes or on a sanction list? This is not a comprehensive list, but there are a lot of questions that you can ask when onboarding a new client to find out if this is a legitimate client, a legitimate business, or if this could be a part of a money laundering scheme. We also said that money laundering is often related to a huge amount of cash and cash deposits, cash-intensive industries, and multiple transactions to create a complex money trail that is difficult to follow. So when monitoring an account or a transaction, a company should look at client behavior and ask questions such as: does it make sense? Does the client ask for shortcuts or unusual speed? Does the client choose an advisor that is geographically distant from the client? Why do they pick a client far away from where they are? Why is the transaction taking place? Does the client attempt to hide the real owner of the business or parties to the transaction? Therefore, client behavior is an indicator. The origin of the money should also be clear. Sometimes the source of finance doesn't make sense, and it might raise questions. For instance, is this a part of private funding from an individual running a cash-intensive business? Is there a third party involved that does not have a connection with the business? Is there any funding that is inconsistent with the nature of business? For instance, if a bike repair shop is suddenly importing pineapples from Latin America, that is a red flag. Importing fruits is not coherent with the profile of a bike repair shop. Thus, it is important to investigate thoroughly before you onboard a client and during the business relationship. Lastly, investigate customer profiles thoroughly. The nature of the business itself is an important indicator of money laundering. Look at the way the business is conducted and find out: is the ownership structure overly complicated without any economic reason to do so? Does the business have any transaction with high-risk countries for money laundering or for funding of terrorism? Is the level of activity not consistent with the firm's profile? For example, a bakery operating in a certain neighborhood should have a certain income where we can expect a certain financial pattern. If the pattern is inconsistent with the kind of business, you might want to find out more about the customer to rule out any money laundering aspect. Ask these questions to figure out if any money laundering scheme may be hidden behind either the client or the transactions. Later on in this course, we will discuss when and how unusual or suspicious transactions need to be reported to the National Financial Intelligence Unit.